Hey, you know, Paul, I was watching TV the other night, kind of surfing through channels, and I stumbled upon this old, bank robber movies, right? The ones that, is all about the setup, and then, there's all that suspense while they're robbing a bank, and then you're hoping for the bad guy to get away, right? And I was sitting there thinking to myself, isn't that, like most Americans in their efforts to build wealth, right? They're always trying to figure out the quick and easy solution, or where's the secret sauce, or how can I build more wealth, right? I mean, or in other words, how can you get that money out of the bank? And so on today's episode of Selling Life and Annuities, we want to kind of talk about, the banking industry and how a consumer, your clients, Mr. Advisor, can do just that. Stay tuned. All right, Paul. So I kind of teed it up. How can an advisor help a consumer do what the banks do?
Well, it's funny because you hear people, facetiously say, well, that'd be great if I could just rob a bank, right? Well, what people don't realize is they can actually do what the banks do. I mean, that's not a stretch to say, if we learn how a bank makes money and we learn some of the principles that they employ to leverage their money, okay, and we start doing that ourselves, then we could create wealth just like a bank does. Okay.
All right. Wait. So the average Joe Blow on the street can somehow, within their economy, create their own bank? I mean, how does that work?
More so than you know. Okay. So let's take a look at how does a bank make money first. Okay. The first concept you have to get out of a bank is a bank doesn't actually bank money. In other words, you go down to the bank and deposit $100. They don't have a box that says Randy Pierson on it. You go back 2 hours later and there's your $100 bill, right? Yeah. Your $100 comes into their bank. They're loaning that back out right away. So the first place they make money is this. They make it on margin. Okay. They give you a paltry amount of interest on your deposits, but they take that same dollar and they loan it out at a higher interest rate, right? So margin's the first place they make money. The second place they make money is they have something called fractional reserve lending. For every dollar they bring in, they can loan the same dollar out up to 10 times because they depend on not everybody coming in to get their money all at one time, right? Okay. The third way they make money is the kind of interest that they charge. So there's simple interest, there's compound interest, and there's amortized interest. So when you have a mortgage and we compound that over 30 years and we shove all that interest to the front end of the loan, we are front loading that note or that mortgage with a high percentage of interest. A 3% interest on a 30-year note has 59.3% interest in the first month you make a payment on the principal and interest part of the payment, right?
Yeah.
So all that combined together, the margin, the fractional reserve lending, and the type of interest, okay, accounts for banks making between 400% and 1,300% interest every year. Okay.
Oh, wow. So, you threw out a lot of information there, and it sounds complex, convoluted, complicated. For the agents watching this video, can you mention some names of some folks that they may recognize that have employed this strategy in the past?
Probably the most two famous names that I could mention are first the Rothschilds, okay? And the second would be the Rockefellers. And what's ironic is that the Rockefellers actually went into the banking industry later on, okay? So let's just use a real life example, Randy. Let's say you hired into BMO Harris Bank, okay? One of the many famous banks out there, right? And let's say you were the divisional mortgage manager for that bank. And so the minute you hire in, they have an insurable interest on you, don't they? Okay, so they take a life insurance policy out on you. And they don't buy the life insurance policy for death benefit. They buy it for the cash value in the policy, right? So you're going to buy the minimum amount of death benefit, maximize the cash value, right? Build money up in that policy over time, okay? And then they could, because they own the policy, they can then take the money out and loan it out at a higher interest rate, right? Make a profit on that and use that to repay the loan back, and do that over and over and over and over with thousands upon thousands of employees, thousands upon thousands of policies, right? And that's why banks own more cash value life insurance than they do buildings and real estate in their tier 1 assets.
All right. Okay, so let's get to the boots on the ground, the nuts and bolts here as to how, what's the secret sauce? How can an advisor watching this video implement this kind of strategy with their consumer to help them build wealth.
Okay. So what we can do is with the average everyday consumer out there, we can go out and we can look in their field, their economy, look at their field of income and money, and what discretionary money could we start allocating to this kind of a banking concept and start building cash up into the policy, and then start borrowing it out to attack their debt or to leverage out in some other kind of way.
Some other asset, right? And
Right.
instead of going to the bank to get a car note, you
Right.
use your life insurance policy.
That's
right?
exactly right.
So here's a question. I think a lot of advisors, they're watching late night TV or Sunday television, and they see the Susie Ormans and the other financial pundits out there kicking life insurance, permanent life insurance, around like a stray dog, right? I mean, what are they missing? I mean, why don't they see this? Why don't they promote this as a tool and see the benefits that you and I would see in permanent life insurance?
Well, the first thing is it doesn't fit their narrative. Okay, it doesn't fit their storyline because they built a storyline around pay the least amount for your life insurance and certainly don't use cash value life insurance. That's the sworn enemy of the public, right?
Buy term and invest the difference.
Buy term and invest the difference,
Yeah.
okay, and put it into the products that they advocate.
Sure.
Mutual funds
Yeah,
and
securities
and things that they are incentivized to promote, and quite honestly, because they're beholden to the Wall Street cartel of sorts, that's why they're getting that kind of advice. Okay, if you look at what do the wealthy actually do, and the Rothschilds, Rockefellers, Walt Disney, J.C. Penney, very wealthy people that built empires using this concept, they do exactly the opposite of that.
Yeah. The gentleman who brought me into the business almost 35 years ago used to say, when he was in front of his prospects and clients, the common denominator amongst all wealthy people is that they own as much permanent life insurance as they can buy, right? And so there's something to be said about that. But so what's last but not least, right? We're running out of time here, but what's the catch? Why isn't everybody doing this?
Well, the catch always is with any financial plan, whether that's a 401k, one of these kind of policies we're talking about, is you can't succumb to instant gratification. You gotta stick to the plan. You gotta fund it, and you have to use it for what it's purported to be used for. The people I've seen in the Your Family Bank program that didn't make it is because they went in very quickly and started invading the policy for purposes other than what it's purported for. Okay, you have to stick with the plan. You have to see it through. Because there is no instant gratification. There's no get-rich-quick scheme. It takes time to build and compound the wealth.
Yeah, but even one step before that, they got to know about it, right? So you gotta know that the opportunity exists, take advantage of it, and then stick to it, right? Yeah. So listen, we run out of time. It's amazing how quick these videos go. But if you enjoyed and got something out of our conversation here today, please do me a favor, subscribe to our Selling Life and Annuities series down below, and click the notification bell so when we come out with a new video every Tuesday, you'll be sure to be notified. But with that, for Paul Bechtold's behalf and myself, I'd like to thank you for watching, and please go out and sell some life insurance today.